In this video, we start to examine the investment policy statement, which is that written document. Your book says it's the starting point for the entire portfolio management process. Portfolio management process. And the learning outcome statements for this section, there are two. One of them asks you to list the major components or appreciate what the major components of the IPS are. We're going to do that in a moment. But also another one is why is an IPS needed in portfolio management? Why do we need a formal written document? Well, the answer is pretty simple. What that document gives you is, as an analyst, of course, or it should give you, is a full understanding, or a very comprehensive understanding of your client's, on the one hand, requirements, what the client wants to achieve, but also the client's constraints, limitation constraints, requirements, constraints, and circumstances. And without this sort of full understanding, so let's say without this, it would be absolutely difficult for us as analysts, as advisors, need a formal written document. Well, the answer is pretty simple. What that document gives you is, as an analyst, of course, or it should give you, is a full understanding, or a very comprehensive understanding of your client's, on the one hand, requirements, what the client wants to achieve, but also the client's constraints, limitation constraints, requirements, constraints, and circumstances. And without this sort of full understanding, so let's say without this, it would be absolutely difficult for us as analysts, as advisors, to achieve success because, well, anyway, you first need to define what success is. You need to understand what the client wants to achieve, and what their circumstances are, what their constraints are, in order to actually define what successful is, what success is, or successful investing is. So, in this section, your book sort of concludes to come up in a question. Be aware of constraints and circumstances, and without this sort of full understanding, so let's say without this, it would be absolutely difficult for us as analysts, as advisors, to achieve success because, well, anyway, you first need to define what success is. You need to understand what the client wants to achieve and what their circumstances are, what their constraints are, in order to actually define what successful is, what success is, or successful investing is. So, in this section, your book sort of concludes that the IPS effectively becomes a plan for achieving that success. However, success may be defined by you and the client. Now, some minor points here as well that maybe should be just mentioned. It's developed together with the client via discussion. It actually, in some countries, is a legally required document. The IPS or some equivalent of it, right? Now for those major components which a separate learning outcome statements asks for, I don't recommend that you actually learn these off by heart. Just appreciate what they are. If they come up in a question, be aware of what the names are. Before I list them sort of fully, let me just say that the really true big ones are going to be a section devoted to client objectives and another section devoted to constraints. those are going to be very very big in the IPS, and the subsequent videos in this section will focus separately on the objectives and the constraints. So objectives will typically, on the one hand, list or define the return requirements, what the client wants to achieve with their money, but also their level of risk tolerance. And as you will appreciate, especially when you cover the subsequent videos, there must be consistency between these. I mean, you can't have a client wishing to achieve spectacular gains, returns, without without exhibiting some tolerance for additional levels of risk that may be needed to achieve this. Now, in terms of constraints, these are going to be sort of limiting factors which need to be considered, or ought to be considered, which need to be taken into account when constructing the portfolio for this client. And you should know the more or less the areas which this could concern, right? For example, a requirement to make sure that we have certain levels of liquidity for unexpected expenses, or a time horizon limitation, or something like some clients. Ultimately, this is not just about advising on portfolio construction where your client would be an individual. It could be also institutional investors, and many institutional investors have certain regulatory requirements concerning, for example, their asset allocation, or the fact that they cannot, let's say, invest in, let's take fixed income securities, bonds, below a certain rating, so only investment grade, but not sort of non-investment grade or high yield. There may be tax concerns or tax constraints, so the tax status of the client may cause us to think about certain constraints, and there will be other, let's say, unique considerations, other unique needs or limitations. Now, these limitations or these constraints, as you can imagine, they may arise from, or they may be internal in the sense of being dictated by the client, so set by the client themselves, or they may be of an external nature, in which case it's not the client who kind of creates them, but they may be set by law or regulation. Like I said, certain investors not being able to invest in assets below a certain quality or take on leverage, let's say, that may be an external requirement. Of course, your book always stresses, and I can't stress this enough either, the need for review of the IPS. It's not something that you write once and then leave it. No, especially these objectives and these constraints, they need to be constantly reviewed against potential changes in circumstances, and many companies will have, or many analysts and advisors will have a policy, let's say, of reviewing at least every, 2 to 3 years, but they'll also have to be constantly looking out for material changes to the client's circumstances, which should spark a review outside of that, every 2 or 3 year cycle anyway. So now for the truly major components, I said that the objectives section and the constraints section are going to be the critical ones, but there are other sections of a typical IPS. The main ones are as follows. Every document will begin with an introduction, same here, and this is where you typically would describe your client. So it describes the client, states who the client is, and some basic facts, right? Now, this will be followed up typically with a statement of purpose. So, why is this IPS being drafted? What is it all about? What is it supposed to do? What's the purpose of the IPS? This is not the section where you kind of go about how much the client wants to earn, what they want to achieve, but why is this document prepared? Very important is the statement of duties and responsibilities. So, for example, here you will lay out what the client is responsible for versus what the portfolio manager is supposed to do. For example, that the client should inform the manager about changes to their circumstances, material changes. Various procedures need to be laid out here as well. For example, the procedures necessary to keep the IPS up to date. So what are the procedures for communicating between client and manager on, for example, updating the IPS? Now, the two big sections that we previously listed or mentioned, client objectives and client constraints, come here. So this is where you describe the investment objectives and the investment constraints, as discussed a moment ago. And of course, we will now, following this video, have separate videos focusing purely on these two, but let me just make the connection here. These two big components are the ones that we've got coming in, but other sections precede them in the IPS. You don't start off immediately with the objectives and constraints. You have those introductory or more descriptive sections. And then investment guidelines. What's this? This is how guidelines. This is a section that describes how the investment policy is going to be executed or should be executed. Should be executed. For example, what's the permissible agreed upon level of leverage? Use of derivatives. Are any asset categories to be excluded? Things like that. Okay. Then you ought to have a section that describes what your book calls evaluation and review. But this is basically laying out the rules and procedures for feedback regarding investment performance. And finally, quite important, appendices. So extra documents which are attached here. And typically, your book talks about this, you would find something called the SAA. Right, it's a good idea to kind of commit this to memory. This stands for Strategic Asset Allocation. It's like and actually this is called sometimes the policy portfolio. It will lay out the baseline allocation to various asset categories. It will not say, which stocks, which bonds specifically ought to be purchased, but what the allocation is, at least the one that's been agreed by the client and the investor. It will typically, one of the appendices will be a policy for rebalancing the portfolio. So rebalancing policy, changing the assets in the portfolio, plus a policy on hedging of risk. On hedging risks, such as currency risk, interest rate risk. Right, so this is the overview of what the IPS typically contains. In the next video, as I already highlighted, we will talk about details. We will discuss the details, especially of the objectives and constraints sections. In this video, we switch our attention to specific components of the IPS. In this recording, we talk about the risk and return objectives, starting with risk and then return, although the risk section is going to be, it will take up more time and more space. So, as we've already mentioned in previous videos devoted generally to the IPS, one of the things you should do as an advisor, as an asset manager, is set risk objectives together with your client. So these will be specific specifications, I guess, for portfolio risk, and they have to be based and they have to reflect. So which reflect? They have to be based on your client's level of risk tolerance, which reflect a client's, a specific client's level of risk tolerance. This is something we'll talk about more extensively in just a moment. Now, the risk objectives themselves may be stated as absolute risk objectives. So an example of this, let's say, coming from your book is, let's say, e.g., that we shouldn't suffer on the portfolio, so not to suffer any losses which would exceed more than, a certain percentage. Right? So this type of absolute risk objective, the thing about it is it's, not related to market performance. It doesn't matter what's happening in the market. The market may be completely crashing, right? But you don't want to lose, or your client doesn't want to lose more than a certain amount, a certain percentage of their capital. So let me say not related to market performance. And you could also describe it as being a self-standing objective. To make it a little bit more sort of realistic, it may contain some statement of probability. So may be a probability sort of related statement, in which case you would say that the objective is not to suffer any losses, or any doesn't make sense here. Not to suffer a loss of capital exceeding X, but not any loss, let's say with 95% probability, in which case you really are sort of enclosing this within a probabilistic statement. And examples of measures designed in this way would be things like value at risk, or maybe encasing these statements in standard deviation terms. Standard deviation, which does indeed bring about, some relation to probability. Okay. Of course, other than absolute risk objectives, you're also going to encounter relative risk objectives. Or in fact, it's also possible to get a combination of these two, of the two in one IPS. Now, here we are talking about the level of risk, but relative to something, of course, relative typically to a benchmark, a sensible, adequate benchmark. This could often be an equity market index, for example. And here it's quite common to find this being expressed in terms of something called tracking risk or tracking error, which sort of measures how much your performance or the manager's performance in terms of risk varies from that of the relevant benchmark. Now, a term that is mentioned at this point in the curriculum in the book is LDI. I'm not sure if this is necessarily the best place for it, but going along with the curriculum and its structure, this stands for liability-driven investing, and it's especially done by institutional investors like life insurers or defined benefit pension plans, or perhaps even individuals who may wish to sort of achieve a certain level of income once they retire, because under liability-driven investing, the risk objective is as much a reflection of the client's assets sort of aspirations, but also their liabilities or expected liabilities. So risk objective reflects both the assets of the client, both assets and liabilities, or indeed, when we think about liabilities, we mean the future obligations. So, like I said, a life insurer, they need to provide for future expected obligations. A defined benefit pension plan needs to make sure that their assets grow so as to meet those future obligations as well. Now, the really important and I think most testable area within this section is establishing what's known as your client's risk tolerance. Risk tolerance of a client is actually a pretty complex topic, which you'll also get to examine once you get to, for example, level 3, and you have to start providing advice or getting ready to provide advice to actual clients based on their circumstances. Risk tolerance has two components to it. One is the client's ability to actually take risk. And the second component is their willingness to do so. So willingness to take risk. And risk tolerance is a function of the two. But it works in a very specific way that we'll discuss in just a moment. So let's take on let's say these two components and define them, starting with ability. a client's ability to take or bear risk is actually the easier of the two, because this is, you could say that it is determined by more or less objective factors. What those factors are things like the time horizon, how much investment horizon does the client have. A client with a longer time horizon has a bigger ability to take risk because there is more space there to potentially recover or recoup any losses that may be suffered on the portfolio, right? What is the client's expected level of income? Once again, if the client is expecting to generate quite a lot of let's say, income from their job, once again, they've got more scope to tolerate losses and therefore ability to take on more risk. What is the client's level of overall general wealth obviously in relation to liabilities that they've got? And let's say the logical assumption here is if the client is more wealthy relative to their obligations or liabilities, they can once again afford to take on more risk. So we're objectively trying to measure how much risk a client is able to take on and bear. However, there is also this second component. What is the client's willingness to accept, take risk? And this is much more difficult to establish because we're talking about the client's, personal, individual risk attitude, which may have nothing to do with, objective factors. It's like asking how comfortable is the investor, is your client, with taking risk. This is definitely more subjective, and it's basically a function of the client's psychology, their traits. To some extent, it will be also influenced, I guess, by circumstances, but it depends on psychological factors like, the personality type of the client, sometimes how confident they feel, their self-esteem, things like that. How do you measure this stuff? Well, it's difficult to measure. It's difficult to quantify. Measured or assessed, I guess, assessed via having a discussion with your client. Discussion with the client. Some asset managers also employ a more standardized psychometric questionnaire, which tries to objectively quantify that willingness to take risk. So, we don't need to know much more at this stage beyond the fact that these two components exist. But what is important is their mutual interdependence or interplay, because ultimately, as a result of trying to establish on the one hand the client's ability to take risk, and on the other hand their willingness to do so, to take risk, you get possibly 4 combinations of the two levels. I'm saying 4 because your book says that each one of these can be either below average or above average. So let's start over here. Ability to take risk. This is risk below average or above average. And same thing here for willingness. It may be below the average level or above the average level. So let's create a matrix here, like this, right, more or less. So it may be the case that your client objectively has below average ability to take risk, and they've got below average willingness, in which case it would be pretty clear that, right, remember what we're trying to do here. We're, via these two factors, trying to establish the client's risk tolerance. So if the two combine and are consistent below average, then your client definitely has below average risk tolerance. Great. I mean, great from the point of view of this making your job as an advisor or manager easier. If the client has an above average ability to take risk and they've got a willingness to suit that, well, we say that the client therefore has above average risk tolerance. Good. What about the two quadrants here where the two are not consistent? Willingness and ability do not match. Well, your book says some resolution is going to be needed, and this is the hard work of the advisor. Resolution needed. Well, I guess things are easier over here, because if your client's objective sort of situation, circumstances, or goals which they want to achieve mean that they cannot really afford to take risk, or too much risk, so the ability is below average, even though your client has an above average willingness. Your job as an advisor is simply to kind of determine that your client has below average risk tolerance. So you kind of go with average risk tolerance. What about this one? This is the really tricky one, and your book also devotes a bit more attention to it. So this is where, let's say, your client could take risk, but they're not willing to do so. And what's going to be sort of the job of the advisor in this case? Well, first of all, counseling the client, in the sense of talking to the client, advising them, explain the consequences of not, let's say, accepting more risk to the portfolio. Explain to them that this could result in returns, expected returns being lower than what we want or what we target. But very importantly, you should stop at counseling, explaining. Your job is not to change the client's willingness to take risks. So if you're dealing with somebody who's naturally not inclined to take risk, you shouldn't, coerce them, you shouldn't push them or force them to do something that would feel unnatural. Advise them, explain, but, and this should be stressed, and I can easily see a theoretical question on this specific point in the exam. It's a perfect question that would catch many people out. The advisor should not in any way change or attempt to change the client's willingness to take risk. Of course, leaving aside situations where the client thinks they're unwilling to take risk, but this results from, let's say, lack of knowledge or misperception of financial markets or products. So unless that low willingness to take risk is the result of, let's say, misperception, then by all means, try to explain, educate the client, and so forth and so on. But beyond that, do not try to make them into somebody who they are not. So something that your book states is that we as advisors should not attempt to change the client's personality. There are other specialists in other fields and belonging to other professional bodies whose job it is to work with clients on personality traits and maybe making them a little bit more risk tolerant, not us as asset managers or investment advisors. However, at the end of the day, if the client sort of sticks to being below average, then in terms of their willingness, and you can't, as you say, you cannot convince them to accept more risk, then ultimately choose or go with the lower of the two. So once again, it's the same rule as before. Choose the lower of the two. In case of sort of conflict, here we had below average ability to take risk, but above average willingness. We still chose below average risk tolerance, and ultimately this will be the case here. If you cannot sort of explain to the client or convince the client towards the merits of taking on more risk or tolerating more risk, we settle with below average risk tolerance as the outcome. But, your job is also to make sure that there is evidence that you try to work with the client to convince them or to kind of explain to them why you think they should accept more risk in their portfolio. And if your client, you didn't manage to convince them, which is absolutely fine, right? document that decision. Document the process, document the decision, so a trace, a paper trail is left, because ultimately you will be judged upon your results. And part of the reason why certain results were perhaps not achieved was the client wasn't happy to accept more risk in the portfolio in terms of asset allocation. So make sure you've got evidence of that written down. Okay. Now, return objectives, because we've spoken a lot about the risk side of things, but this video is both about the risk and return objectives as set in the IPS. And you think, well, these should be paramount. Well, they come sort of in second order, and there isn't so much talk here about them. So your book says these return objectives could once again be stated in an absolute sense. So, for example, specifying some actual rate of return which the client wants to achieve, or we want to achieve together with the client. Or they could be obviously stated in a relative sense, in a relative way, relative to a benchmark, or perhaps some peer group of, asset managers. It's important here also to think about, are we stating this before or after fees? And it's important to make sure there is clarity between the advisor and the client, or the manager and the client on this, because it must be understood by both sides how those returns are actually going to be, how the objective is stated. Many clients get surprised by the fact that fees get deducted, but the return was achieved, but not on an after a post-fees basis. Plus, additionally, are we doing this pre-tax or post-tax, which for some clients is going to be very, very critical when they are obviously subject to various levels of taxation. Right, your book also says some pretty obvious things, but they are quite important anyway. The returns objective must be realistic, right? It must be consistent with the risk objectives defined previously. So if you've identified below average risk tolerance, you can't aim for returns that are, cosmic and astronomical. You probably won't be able to achieve that. And they must also be, those returns objectives absolutely consistent with the economic environment and the market environment around you. If a client has unrealistic objectives, it's your job as an advisor to counsel the client. So this is where the job of a financial advisor really relies on building a relationship of trust, talking to the client rather than just computing numbers. And when you get to level 3, you get to tackle a lot more of these types of problems. In this video, we tackle the second major section of the investment policy statement, namely the constraints section. And here the book is very clear on there being sort of five groups of constraints, which we will discuss one after the other. They are liquidity requirements, time horizon constraints, tax concerns, regulatory and legal factors, and unique circumstances, which also include ESG considerations. So please learn these 5 categories. You may be tested on, even your knowledge of the five distinct groups. So let's get cracking. The first one is liquidity requirements. The IPS should state likely needs, to withdraw money, likely needs to withdraw funds from the investor's portfolio. That could be for, in the case of individuals, for things like healthcare costs, education costs, right, tuition fees, things like that. In the case of an institutional investor, like an endowment, for example, spending rules, on what money, for what money may be spent out of the portfolio. Of course, why is this important? Because the need for liquidity at, let's say, perhaps a specific point in time, forces the manager to allocate part of the portfolio to cover those needs, to make sure that they are met. And that could mean investing the money into lower risk assets than the rest of the portfolio, keeping them in something which is more liquid as well, so that the money can easily be, or that the assets can easily be converted into liquidity at what is an upfront, well-known value. Now, the second consideration, or the second constraint we have, are time horizon constraints. Here, you need to state in the IPS what the investment horizon is for for this whole exercise of investing money, because it's typically not indefinite or infinite. Well, unless you're an institutional investor like an endowment. But in the case of individuals, you typically say that this whole investment policy statement has a horizon until the assets need to be withdrawn, which may be at a specific point in time. For example, when the client plans to retire, or maybe buy a property somewhere, right? Or you may say that the horizon is until the time when there is a material change to the client's circumstances. That's also how we can sometimes phrase this. Now, once again, the time horizon absolutely does influence the way in which the manager works with money, because it should impact the level of risk and liquidity for the asset allocation. The more time the asset manager has to work with the money, the more scope there is to potentially recover from losses. If the time horizon is shorter, that also curbs our possibilities with regard to risk taking. Okay, third constraint, tax concerns. This is very client specific. Now, you will not be asked for specific advice here in any way or specific diagnosis, but, you need to understand the client's tax status, whether they are, subject to tax, and what tax, because there are different taxes in many countries, or perhaps tax exempt, as many or some institutional investors may be, maybe foundations, or perhaps certain pension funds in certain countries. This will also be impacted by the tax jurisdiction, like what is the treatment of capital gains, so gains arising from the growth in value of assets, versus the tax on current income in the form of dividends or coupons. In some countries, interest made on specific bonds, like municipal bonds, is exempt from certain types of tax. An investor who is taxable or is subject to taxation may prefer to get most of their wealth appreciation in the form of capital gains, so as not to pay income tax on dividends and interest. Other investors who are tax exempt may be indifferent between growing the value of their portfolio in the sense of capital gains versus income generation. I mean, all of this has to be diagnosed at the very beginning. The third constraint are so-called legal and regulatory factors. And I mean, this is pretty obvious. Certain investors, like pension funds in specific countries, may, let's say, have investment restrictions. They may be prohibited from investing money in specific assets, or assets belonging to a specific group, like bonds below a certain level of rating. The same could apply to individuals. If you are advising or managing the wealth or money of, let's say, somebody who's a company insider, so they hold a relatively high position in a company whose assets are listed on a stock exchange in the public markets, then that individual may possess non-public material information, and it's not the case that you shouldn't necessarily hold shares of that company in the portfolio, but there probably will be times in the year, especially around or prior to earnings releases, things like that, where trading should not be done in those shares, so as to avoid any suspicion that this was based on insider information, things like that. The fund manager or the asset manager or the advisor must be aware of these specific constraints. Now, the fifth one is going to be so-called unique circumstances. And your book also here talks about ESG considerations, which I mentioned would come up. Good. Good. Now, this segment, so to speak, is mainly devoted to everything that doesn't fit elsewhere in the sections already discussed, but especially restrictions or constraints that result from the client's beliefs and values. Now, beliefs and values, I mean, they could be faith-related. They could be just moral values which your client wants to adhere to. Obviously, beliefs and values which may have a material impact on the whole exercise of portfolio construction. And, you have to be aware of terms like SRI, for example. This is socially responsible investing, where a client may not wish to have their funds allocated to certain industries or companies. Those involved typically with weapons production or trading, tobacco, maybe alcohol, maybe gambling. But they would like, in a positive sense, that money to be invested into stocks of companies who are, who uphold certain labor standards, who care about their environmental impact, and so on. I'm sure you get the idea here. Now, of course, very much related to SRI is ESG, so environmental, social, and governance factors in portfolio construction. And your book decides here to list some ESG investment approaches, which I guess, because they make a nice list, is something you ought to probably not memorize, but just appreciate what they mean. There are 6 of these ESG investment approaches. The first one is pretty obvious: negative screening. So this is incorporating ESG into the investment process by this video, we start to examine the investment policy statement, book conclusion of constraints that result from the client's beliefs and values. The first one is pretty obvious: negative screening. So this is incorporating ESG into the investment process by excluding. So this is all about exclusion of specific companies which obviously fail to meet certain criteria or sectors. Maybe they are heavy polluters, right? Or they exploit, cheap labor in places where labor standards are, let's say, not a top priority. Then you've got positive screening, which is sort of the flip side, the reverse or the mirror opposite of negative screening. It's all about including, or the inclusion of, specific companies and sectors because you feel, or we know that they are positive from an ESG point of view. Number 3 is a very sort of generic one. It's called ESG integration. And this is beyond simple negative, positive screening. This is sort of more holistic. It's the systematic consideration of material ESG factors in portfolio construction. So hopefully you get the you get the idea that this is more complex than just negative screening or just positive screening. It's sort of more holistic. There's also an approach which your book calls thematic investing, which means focusing your investments, investing in specific themes, so like topics or assets that are related to ESG factors. And one idea I can sort of share with you here from my own observation is a theme that's become quite popular in the last couple of years is building portfolios of companies that belong to the so-called circular economy sector. So buying stocks or debt of companies that promote let's say, the reusal of and circulation within the economy of products, goods, etc., instead of throwing things away. This goes beyond recycling, right? It's a much more sort of complex theme. Now, and the next one is engagement, stroke, active ownership. So this is like activism in the world of hedge funds, where you use your shareholding, the fact that you hold shares, so using your shareholder power to actually try and influence some changes for the good, to influence corporate behavior. Corporate behavior, obviously, towards ESG, sort of compliant or ESG goals. And the final one is impact investing. And this goes beyond just buying stocks or positive screening, negative screening, excluding stuff from your portfolio. This is actually investing with the purpose of making a positive social or environmental impact. So let me write this down. Investing with the intention to make a positive either social or environmental impact, but also, of course, financial returns. So perhaps, providing money to startups that want to change the way in which energy is being produced and actively working with them to help achieve those goals. I don't know, probably requires quite a hefty portfolio to be able to make that kind of impact, but it is one of the 6 approaches to ESG investing which your book lists, and which I think you should kind of appreciate what those names are. Right, let's just finish off by stating that, while we describe constraints here, you as a manager, as an advisor, should also be aware possibly of whether the client doesn't have some additional investments somewhere else. Maybe, they already hold some employer stock options or stocks that have been granted by their employer. That should also be considered in your portfolio construction, so as not to sort of double the same investments. And of course, especially if somebody's still working in a specific industry, think about whether it would be a good idea to allocate a section of that portfolio to stocks of companies from that same industry. Because if somebody's generating their income by working, let's say, I don't know, in the training industry or the education industry, and then you buy into the portfolio stocks of education-related companies, you're not diversifying the risk, but you're doubling the risk. Because if the education industry, let's say, goes into a slump, or any other industry for that matter, then the risk may hit twice. Once because they may lose their job, and second because the investments which we made in the portfolio also lose value. So, things like that need to be considered. And there's also a very, let's say, little section in your curriculum on gathering client information. I mean, we did mention a few ideas concerning getting information from the client beforehand in the previous video, where we talked about risk and return objectives. So, of course, a lot of this information gathering will happen at the very start of the sort of relationship between the client and their advisor, although as we often emphasize, there is need for subsequent updates to the IPS. So, aside from pretty obvious things like objectives and requirements, possibly the manager will also, or the advisor will also need to get some info about the family situation of the client. That typically is important. Their health situation, which may help plan for, liquidity needs, and therefore impose certain liquidity